Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Battalion Oil.
If you find our talks useful, please consider subscribe, like, and comment underneath. So today we are looking at a really fascinating setup for you.
Yeah, it's what you'd call a classic capitulation reversal setup.
Right. A stock that has just been completely, well, heavily beaten down.
Systematically dismantled.
Exactly. It's been left for dead by the broader market algorithms. But suddenly it's flashing these massive, totally unexpected signs of life.
And it is exactly in these pockets of extreme market pessimism where you find the most asymmetric setups. The institutional memory on a name like this is just incredibly short, which means when the fundamental narrative actually shifts, the repricing happens much faster than most retail models can even adjust to.
Yeah, so our mission today is to unpack all of that for you. We want to figure out whether Battalion Oil's recent, frankly, explosive price action is just a temporary blip
or if it's the beginning of a massive 50 to 100% operational turnaround.
Right. And most importantly, we're going to map out exactly how you can position yourself for the upcoming earnings catalyst.
But to do that properly, we have to start with the ugly reality first.
We do. We have to validate the skeptics here because they have a very strong historical argument.
Very strong. When you look at the fundamental tug-of-war, the top-line trajectory is, well, it's brutal.
It really is. Yeah. We are talking about a 3-year revenue decline of negative 20.62%.
Yeah.
And the bleeding hasn't stopped, you know. The recent quarter-over-quarter revenue contraction is sitting at negative 16.3%.
Right, which brings their trailing 12-month revenue down to just $183.42 million.
Which, for anyone running a conventional growth model, a consistent slide of that magnitude is usually an immediate disqualifier.
Oh, absolutely. It triggers all the automated sell algorithms. People just assume the underlying business is shrinking into oblivion.
But and this is where we get to the bullish plot twist.
The anomaly.
Yes, the anomaly. If you look at the underlying engine of the business, despite that severe revenue shrinkage, Battalion Oil boasts a staggering 100% gross margin.
And that is the absolute crux of the thesis. I really want to emphasize why this specific margin metric matters so much for you.
Because it sounds almost like an accounting error.
It does. I mean, extracting physical oil and gas from the ground usually carries massive variable costs. But a 100% gross margin demonstrates exceptional cost management and incredible pricing power.
Yeah, they are extracting hydrocarbons at costs that are so significantly below market prices at the gross line.
Exactly. It creates what we call an operational inflection point. It means that if management can simply stabilize the top line, if that revenue just stops shrinking, profitability can absolutely skyrocket.
Because every marginal dollar flows right past the gross line with zero friction.
Precisely.
But to be fair, that friction definitely shows up further down the income statement.
It does.
I mean, they have a negative net income of negative $735,000.
Right, but you have to look at what's driving that. That negative net income is heavily distorted by non-cash charges and financing costs.
Paper losses, essentially.
Exactly. When you look at the actual cash-generating capacity of the business, it's a completely different story. Cash is king, as they say.
Always.
And despite that negative net income, Battalion Oil generates a highly robust $27.97 million in operating cash flow.
Wow.
Yeah. And a very solid $18.69 million in EBITDA.
That divergence is just critical for you to understand. They are generating real, tangible liquidity from operations.
Which proves the core extraction model actually works. But of course, cash flow in isolation isn't enough.
No. We have to look at how that cash interacts with the rest of the company, which brings us to the balance sheet and their competitive moat.
Right. And the balance sheet here is incredibly asset heavy.
Let's break those numbers down. They are holding $491.69 million in total assets.
And that's mostly the actual oil and gas reserves in the ground, plus the production infrastructure.
Right, hard assets. And you stack that against $300 million in total liabilities.
Which leaves you with a very solid net asset position of nearly $192 million.
It's a massive margin of safety. But we do have to address the debt question.
We do. Leverage is always the elephant in the room with these capital-intensive names.
Right, because their interest coverage ratio is sitting at just 1.4x.
Yeah, 1.4x is tight. There's no getting around that. But you have to calmly assess the broader context here.
Which is?
It's entirely serviceable, given that $27.97 million in operating cash flow we just talked about.
Assuming there are no major disruptions to that cash flow.
Exactly. And what gives me confidence there is their disciplined capital allocation. They are making very prudent cash flow maneuvers right now.
Like the $5,000 in net investment properties.
Exactly. They aren't burning cash on wild speculative bets. They are managing the capital structure tightly to survive the revenue trough,
And all of that ties directly into their competitive moat.
which is pure operational leverage.
Right. Because they have isolated their costs into a fixed, the depreciation, the general and administrative costs. They've effectively set a floor.
Yep. So any future revenue growth is going to flow directly to the bottom line at a massive multiple.
Which perfectly sets the stage for the technical breakout. This is where we follow the smart money.
And the tape action here is just fascinating.
We are talking about a massive market event that happened on February 27th, 2026.
It was an absolute ignition point.
The stock surged a whopping 40.52% in a single day.
And there was actually a separate report that noted a 25.84% surge tied to the exact same event.
Right, depending on the data feed. But the catalyst was clear. It was driven by news hitting the wires about a strategic acquisition and strategic partnership.
Which completely woke the market up. If you look at the intraday price action details around that surge, it opened at $5.11.
Which it established as a new rigid support level, rather than selling off like these beaten down names usually do.
Exactly. It held that line, absorbed the selling, and closed at $5.22.
After testing heavy overhead resistance up near $5.88.
Right. Well, we have to zoom out for you to really see the capitulation setup here.
Yeah, because context is everything. Even with a 40% pop in one day, the stock is still down 30.8% year to date.
And it's down 79% over the past year.
79%. The weak hands are completely gone.
They are. And that's why this volume spike is so important. A single day 40% volume spike heavily implies institutional accumulation and short covering.
The smart money is stepping in.
Yeah, they're looking at that $192 million in net assets and betting that the bottom is finally in.
But to validate that bet, we have to look at the macro environment. Sentiment, geopolitics, and of course, the bear case.
Right, because energy does not trade in a vacuum.
No, it doesn't. So let's frame how the broader energy sector is moving based on international news.
Just looking at the timeline on February 5th, energy stocks traded lower on news of U.S.-Iran peace talks.
And then the narrative flipped. By February 18th, they rallied on Iran nuclear tensions.
Exactly. And it is crucial that we maintain absolute neutrality here. We are simply explaining how this geopolitical risk premium impacts commodity prices.
Right. Regardless of the politics, that friction creates a risk premium that supports underlying commodity prices, which directly supports Battalion Oil's cash flow.
It provides macro air cover. But even with that macro support, you still have some intense analyst skepticism.
Yeah, one industry expert recently gave the stock a negative sentiment score.
Basing it on profitability and weak sector positioning.
But, and this is a massive, but that rating came out before the late February strategic acquisition news.
That is the key detail. The sell-side models are backward-looking.
Right. The market is currently repricing this stock in real time on data that those analysts haven't even fully factored into their spreadsheets yet.
Which is exactly where you find the structural mispricing. However, we have to keep you grounded. The risks here are very real.
Let's walk through the bear case. Risk number one. The profitability on paper remains awful.
Very tough to look at.
We are seeing a pre-tax margin of -8%, a profit margin of -21.8%, and a brutal return on equity of -657.46%.
Now, obviously, that ROE is mathematically distorted by historical losses wiping out the book equity, but it still triggers institutional red flags.
It does. And risk number two is their extreme sensitivity to volatile commodity prices.
Yes. They are a pure beta play on oil and gas. If prices drop significantly, their cash flow compresses.
Even though it is buffered by that 100% gross margin we talked about earlier.
Right. They won't bleed cash at the wellhead, but top-line sensitivity is just a permanent reality for them.
Okay, so let's summarize the scorecard for you. Taking all the fundamental buffering, the institutional flow, and the macro setup into account.
Battalion Oil gets a bullish score of 7.5 out of 10.
7.5 out of 10. And the risk-to-reward ratio here is highly asymmetric.
Because a 79% year-to-date decline means the worst is very likely already priced in.
The downside is capped by hard assets, while the upside is explosive.
So, let's give you the playbook. How do you actually trade this?
We are looking at specific target horizons. For the near term, we see a 3 to 4 week swing trade.
Leading right into the March 26, 2026 Q4 earnings report.
Exactly. You are targeting a 20 to 30% move if management's guidance is positive and clears up the acquisition details.
And then for the medium term,
It becomes a 6 to 12-month multi-quarter hold, assuming the earnings actually validate the turnaround.
but you must have an exit trigger.
Always. You sell if the March 26 earnings disappoint on revenue, or if the new acquisition fails to show real synergies. Respect the data.
Never hold through a broken thesis.
Never.
To wrap things up, we want to leave you with a final provocative thought to ponder on your own.
Yeah, think about this as you build your own models.
We know a strategic acquisition caused that massive 40% stock surge, but the exact details are still totally opaque.
We don't know the specifics yet. Right. So if this mystery acquisition introduces high-margin assets or fundamentally shifts their reliance away from traditional commodity price volatility,
How radically could that alter Battalion Oil's ceiling moving into 2027?
it could change everything. Thank you so much for joining our analysis today. If you found this useful, please subscribe, like, and comment below. We will catch you next time.